Hello, everyone, and thank you for joining us today. Thank you for attending, and thank you to all the good people at FX Street for giving me the opportunity to speak and teach. My name is Steven Primo. I am the president and founder of SpecialistTrading.com, and thank you for those of you who aren't familiar with Specialist Trading. We are an educational company, and we are your premier source for online education in trading, and trading just about all of the markets. So we're going to give you some great education here today, things that you can use as early as today if you'd like. My name is Steven Primo. Once again, I'm the president and founder, and just to give you a little bit of background about myself, I have been actively trading the markets for roughly about 35 years now. I first started trading on the floor of the Pacific Stock Exchange. I was on the floor for 16 years, and 9 of those years I was a specialist for Donaldson, Lufkin, and Jenrette. I traded through just about every conceivable market environment, the crash of 1987, the markets that followed afterwards. I traded through choppy markets, through trending markets, and in the mid-90s I left the floor to pursue my trading of my own account to manage money. And in roughly the last 3 to 4 years, I've gotten heavily into teaching. A lot of people that I've known and people referrals have asked me to mentor them and to teach them. And so I was also asked to become a director of education for many educational sites. But 3 years ago, I started Specialist Trading, which you see here in front of you, which is my own site, which mainly deals with just everything that I personally use, everything that I learned from trading on the floor, everything that has helped me to be consistent through these 35 years of trading. And this is basically what I teach and mentor on to my students, all of the information and the tips and techniques. And I'm going to be sharing with you some really great tips and techniques, because today we're going to be talking about the 3 key elements to a winning Forex strategy. Now, you can use these elements, as I said, as early as today. These are not an actual strategy. I'll show you how you can put them together and formulate your own strategy. But what there are 3 key elements that I want you to use and you should look for regardless of which strategy you use, whether it's one of mine, something from another educator, or something that you come up with yourself. You should be applying these 3 key elements to your winning Forex strategy, or to your Forex strategy, in order to make it winning or give it a high percentage of success. Okay, so I'm going to explain exactly what they are and go into it. But for those of you who like a little bit more information about myself or any more information about Specialist Trading, I want you to please go to this link here. This is a microsite that FX Street has provided for Specialist Trading. This is the link that will give you more information about me and my company. And I realize it's a little bit long there, so we've shortened it for you. If you'd like to copy this one down here, this is a lot shorter. You can copy this down and go directly to the microsite that FX Street has on their website. Let me just give you a little snapshot of what it is. It'll give you information about myself, as I said, and if you want more information about my courses, about my strategies, about what we offer for our students and our mentorees, you can simply go to the course description and learn about that, okay? Now, before we begin, we're required to show you and make sure that you read our disclaimer. I'm going to show you a lot of performance results using these 3 key elements. But remember that we can in no way guarantee that any of these results will be repeated in the future. So please take a moment just to view our disclaimer before we begin. And I'd also like to mention that I know I see some of the faces and names here of people that have attended my presentations with FX Street in the past. And if you've done that, I'm sure you're aware that the way I like to teach my style is I like to have a question and answer portion, but I like to save the questions to the very end. So I know a lot of other teachers like to have an interaction with the questions as the presentation is going. I found that to be a little bit fit and start kind of environment, because we kind of stop and start and stop and start. I'd rather have the presentation run smoothly and then reserve the last 15 minutes. So if you don't mind, I really appreciate it. Just simply write down a question if something doesn't make sense or you don't fully understand it, and I promise I'll answer it fully at the end of the presentation. We'll reserve time for that. If we happen to run out of time, which I don't really think we're going to, but if we do, I'm also going to furnish you with an email address as well as a phone number where you can contact us and have any question answered, okay? So there's lots of ways to contact, lots of ways to ask questions, but please just wait till the end of the presentation, okay? I know some people come in late and they don't get this, so I may have to bring it up again, but remember, just any questions, write them down, and I promise I'll answer them at the end of the presentation. All right, so I'd like to just begin talking a little bit about how my trading started and how I gained the specialist edge. As you know, I was a specialist, as I just went over, but I had a very difficult time in my first few years of trading. I know a lot of people will say, well, Steve, you've been trading for 35 years. You were on the floor. how could you have trouble? You must have been successful all this time. Well, that's not really true. I had to really learn just like everyone else did. And in the first couple of years of my own trading, I really was questioning and doubting whether I was going to make this a career or not, because I just couldn't seem to get going. I couldn't seem to get out of this kind of break-even mode. I'd have 3 or 4 great months followed by a disastrous month where I gave literally everything back that I had just made in 3 or 4 months of hard work. And I know this must sound familiar to a lot of you, because this is what the majority of most traders go through. They really start to feel confident, and then they give it all back, and then it's like, what am I doing this for? And I know a lot of you may be struggling with the same issues today. That's why you're here, to get some knowledge. And I know how you feel, because this is exactly the way I felt. I really struggled and wondered if I was in the right career, if I should be staying as a specialist or in the trading mode. Well, I finally came in contact with a few elite traders on the floor. These were specialists as well, but they were able to consistently generate gains and profits. And they really taught me what it means to be successful, because I think I was looking at things the same way a number of you are, looking to hit home runs. I wanted to become a millionaire as quickly as possible. I wanted to just have every trade be a winner. I wanted to have tons of money that every trade produced. And they taught me that, Steve, that will come with time, but what really you should be focusing on is consistency in your trading, because consistency will allow you to become successful. It's not about hitting home runs. There are tons of traders who made hundreds of thousands, if not millions of dollars in 1 year that I saw trading on the floor. But I would venture to say that the majority of those traders have lost everything already. They are no longer even trading. So that really is not the definition or the goal of success, and that shouldn't be something you're pursuing. What you should be pursuing is consistency, a 2-step forward, 1-step back approach in your profit and loss statement. All right? You shouldn't be looking to hit home runs. I know a lot of teachers and educators promise you the world. I don't promise you the world. I promise you consistency. That's what I'm looking for. I'm trying to make sure that you have consistency in your trading. There's no guarantees. There's no guarantees or finalized approval that this will happen, but I've set you on that road so that you will be looking for more consistent gains. I mean, the main thing that I was trying to do was, once again, hit home runs, and what you should really be trying to do is hit singles. All right, singles are what is going to sustain you in your trading and what you can rely on. That will give you the opportunity to be trading 20, 30, 40 years down the road, just as I have now. So it's not about hitting these home runs. So I finally talked to these elite traders and said, well, how do I get this consistency? And they really said the main thing about consistency is keeping things as simple as possible. You see, when you complicate your trading, when you're involved in too many trading rooms, when you're looking at too much news, too much information, when you have too many technical indicators, that's when you get in your own way. And sooner or later, you take yourself out of the game. You're no longer a part of the process. You're relying on these outside things to tell you what to do. And so when you strip these things away, when you really keep your trading as simple as possible, that's when you get onto this road to consistency, which is really the specialist edge. So my goal is to teach you the same things that were taught to me that turned my trading around, that's able to sustain me for 35 years, and that's the trade with the specialist edge, which is rooted in simplicity. A lot of things I'm going to be teaching you and showing you here today, and what I teach in my courses, are extremely simple. In fact, most traders have heard of or seen them before, but they don't know how to implement them properly. They don't know the structure they're involved in within a really nice strategy. This is what we teach at Specialist Trading, and I'm going to share some of these things with you today. Okay, so that's the philosophy behind Specialist Trading, keeping things simple, going for singles instead of home runs. Okay, so let's talk about what we're going to be learning today. I'm going to give you the 3 keys, the 3 elements to a successful or a winning strategy, and that is key number 1. You must trade in sync with the market, but easier said than done. How can we trade in sync? It's very difficult to try and figure out what the market's doing. I'll give you one of our best edges for doing that. Key number 2, price bar pattern. This is going to be something that you should be looking for in any strategy, in any type of trading. This is a particular price bar pattern that you should be really trying to focus on. And it doesn't matter if you're a day trader, it doesn't matter if you're a weekly or a long-term investor or trading 5-minute bars. It doesn't matter. You can spot this bar in any time frame. And then lastly, once you put the 2 keys together, key number 1 and key number 2, I'll show you an entry technique, how you can apply all of this and have a high percentage entry technique to get involved in the market. But remember, once again, these are just 3 elemental keys for successful trading. They are not an entire strategy. So you can use these keys to apply to your current strategy, and hopefully you'll get the winning percentage up much higher. Or you can actually formulate your own strategy based off of these three keys. All right. So get out your pencils and papers once again, and I just want to repeat, I appreciate you writing down your questions. I'll answer them all at the end of the presentation. I'm not going to take any questions while the presentation is going on, so we can fully understand the process here. All right. So let's look about buys. Let's talk about buys. What if you're thinking about going long the market? Let's say you like a particular currency pair and you want to go long. How would we apply these three key elements to going long? All right, key number one. Remember we talked about trading in sync. Key number one, you must apply this to every strategy regardless of what it is, but you must trade in sync with the trend. All right? I know so many traders are just so set on trying to pick tops and bottoms. And once again, that's the way I used to trade. I would trade the same way in the beginning of my career. I tried to pick a top and a bottom, and this would work 9 times out of 10. But it would be that 10th time where it didn't work, and I literally gave everything away. So this is not something we want to rely on. This is not, something that that will sustain us trying to pick tops and bottoms. So how do we remedy that? We trade in sync with the trend. But as I stated, it's much easier said than done. How do we figure out what the trend is? There are 1,001 ways to discern trend. Right? Every educator, every teacher has a different way for finding trend. Well, remember I said how we want to keep things as simple as possible. This is the way my mentors taught me. Let's look at a chart here of the Swiss franc. As you can see here, we're kind of in a range here, but as you see in the very beginning of this range, we headed lower, and then we stopped and went higher, and then the last couple of days here going into the beginning of July, we went lower. So there's really no way to find out what the trend was on this short-term basis. How can we really discern? If we're traders, it doesn't really matter. We're looking at daily bars here, but this could just as easily apply to a 5-minute time chart, or it could apply to a weekly or a monthly chart. So how do we discern what the trend is? Well, we keep things as simple as possible. We don't have all these convoluted indicators or listen to the gurus on TV tell us what it is. We listen to the market. And the easiest way to listen to the market is by simply applying a 50-period simple moving average. Okay? This is our first key. It doesn't get much simpler than this. And simply, the only thing you want to know is if price is above the 50-period simple moving average, the short-term to intermediate trend is up. So that's all you need to know. This automatically, addresses everything so that you don't have to think about going short. We're only going to be looking to go long now. It can't get any simpler than that. So apply a 50-period simple moving average to any time frame, whether it's a 5-minute or a weekly bar chart. Does not matter. And if price is above, or for all intents and purposes, the majority of price bars are above, then you're just going to be looking for long situations or long setups. If price is below, we'll just look for short situations or short setups. Doesn't get any simpler than that. All right, key number 2. All right, we've discerned which way the trend is. Now we want to look for a bar that closes in the top 25% of its range. Now, why are we looking for that? Because this is the market giving us a clue that if it closed towards the high, most likely it's going to continue in that direction. All right, so we're looking for something that closes either at the top or the top 25% of its range. Remember, once again, it does not matter if it's a 5-minute time frame or a weekly bar. It does not matter. This is the market. Once again, not an outside source, not an indicator, not some chat room, but this is the market, the most important thing telling you that the odds are we're going to continue in that direction. And this is the only thing you should be listening to. All right, so we look at the chart here. We see that price is above the 50-period simple moving average. So we look for those bars, and we have 3 bars right here in green that closed in the top 25% of their range. Okay, so once again, the market now is giving us a clue that these are high probability setups for going long. All right, so now let's apply key number 3. If we have some type of formation at the beginning of some type of strategy, how would we enter? Well, key number 3 is we're going to enter upon the confirmation of the trend. Well, what does that mean? I thought we had already figured out what the trend was because the price was above the 50-period simple moving average. Well, we want to enter upon confirmation of trend, and here is the confirmation method. This is something that we teach to all of our students, and you may want to write this down. If we're using this confirmation of trend, what this means is once you get a signal, all right, in a strategy, you're going to, if you're going long, you're going to buy on the next bar only in this case, if price trades 1 pip above the bar that closed in the top 25% of its range. Okay, so in other words, that's our confirmation. If we go higher than the bar that closed in the top 25% of its range, the market is confirming that we're most likely going to continue in that trend. But it must happen on the next bar only because we want this momentum. You see, we want the momentum to tell us that we're continuing in that direction. All right, I see some people are asking questions. Remember, we're only asking questions at the end of the presentation. All right, many times your questions will be answered if we just follow along and stay with the presentation. Okay, so that's the confirmation method. Let's go back to the chart again. We're above the 50-period simple moving average. We have the green bars here that show us that we closed in the top 25%. So what we want to do is buy on the next bar only if we trade 1 pip above. Now, here was the next bar. As you can see, we never got up to that level. So we never went long. So the market never confirmed it. That's great. We didn't lose any money. We didn't gain anything. We're just on the sidelines. So that we're just waiting for the market, once again, to tell us what to do. We're not waiting for an indicator. We're not waiting for some chat room or some trading guru to tell us what to do. We're simply waiting for the market. That's the most important thing you should focus on, is that all the information you want is right in front of you in the chart. It's a lot easier to learn. It's a lot easier to figure out, and it's a lot cheaper. You won't have to spend so much money because you have the chart right in front of you. All right, so let's look at the next bar here. All right, did we trade above? Yes, we did. We traded above, so this would have been a point of entry if we had some type of strategy in place. Remember, these are just key edges here. They're not a strategy. But once you would have entered at this point, look what happened. We had a nice run-up of roughly about 100 pips. The continue of the trend and of the momentum continued in that direction for about another 100 pips. But let's look at this last bar here, which was, once again, a bar closing in the top 25%. As you entered here, you would have seen that the bar, the very next bar, actually did go above there. And so one would have entered, and one would have said, look, Steve, we entered, and look what happened. The bar went lower. We're not concerned with that. This is not an actual strategy. We're just looking to catch trend here. But look what happened. In the days to follow, you would have had a very nice run-up going into July here, mid-July, in the Swiss franc. This is all without the aid of trying to figure out what's going on economically. You're not listening to interest rates, not listening to the talking heads on TV, but just listening, once again, to the market. See, once again, if you keep things simple, this will give you the opportunity to go on that road to success rather than trying to complicate your trading. My mentors taught me, they said, Steve, it's the easiest thing in the world for anyone, whether you're a beginner or an advanced trader, it's the easiest thing in the world to complicate your trading. Anyone can do that. You can buy 12 different strategies. You can be along in 20 different chat rooms. You can have 20 different monitors in front of you. It's easy to complicate your trading, but it's the most difficult thing in the world to simplify it. But once you open up the roads to simplifying your trading, you'll see that you're opening up the roads also for consistency. All right, let's look at sells. Let's turn the coin upside down and see how we would apply these key elements to going short. All right, key number one. We must trade in sync with the trend. But how do we figure that out if we want to go short? Well, again, here's a chart of the Australian dollar this time, and we kind of have a rangy market here. How do we know which direction to go short going into May or roughly? Well, we have a downward move that followed by an upward move and then a downward move again. We simply keep things as simple as possible by applying the 50-period simple moving average. And we ask ourselves, where is price in relation to that? It's obvious that price is below, so right off the bat, we don't have to ask any questions anymore what the short-term to intermediate trend is. We automatically know that the trend is down. So we're only going to be looking to go short. We're not going to listen to anybody. We're not going to take any signals to go long. We're only looking to go short. That's how simple it is. You automatically cut out 50% of the trouble and of the work. We're only looking at shorting opportunities because we're below the 50-period simple moving average. All right, key number two. Now we want to look for a bar that closes in the bottom 25% of its range, okay? So instead of looking for something that closes in the top, we're looking for bars that close in the bottom, and we have 4 right here, all right? So once again, this is not a strategy. This is not a system. These are just keys of telling us which direction the market may be going on the short-term time frame and keys to apply to a strategy or to build a strategy off of. All right, now lastly, once we have these keys, once we have these edges, how do we enter? Well, we're going to enter upon confirmation of the trend. Now, before we wanted to see price trade 1 pip above those green bars. Well, now, since we're going short, we want to sell on the next bar only if price trades 1 pip below the bar that closed in the bottom 25% of its range. Remember, if a bar closes in either the top or lower portion of its range, it's giving you a clue as to which direction it wants to go. So if we continue past that, either above or below, most likely we're going to catch that wave of momentum. And that's all we're trying to do. We're just trying to be in sync with the market. Remember, key number one is trade in sync. Never try to bet against the market. Never try to say that it's gone low enough that it's oversold or it's gone high enough that it's overbought. So one of the main things my mentors taught me is that there's no such thing as overbought and oversold. Markets can go as high and low as they want, especially the Forex market. So just try to, rather than fight it and try to pick a top or bottom, just jump on board. Just go with it. A lot easier, and you'll sleep a lot better at night. So we go back to the chart where we have the bars that closed in the bottom 25% of the range. And we see here that this is where you would have entered. Now, on each one of these first three here, not much momentum in that direction. We see here that had you entered at this point, you roughly, taking all of the momentum to the downside, you would have gained about 75 to 100 pips, but not a lot of room for profitability. As we see on this bar here, though, had you entered right when we traded 1 pip below, nothing would have happened once you entered. In fact, you would have turned it into a paper loss, but holding on to a position for the next couple of weeks, you would have seen that the market had been giving you a clue, early clues in fact, but it was just a little bit too early. But ultimately, the market gave you a clue that we were going much, much lower because we were below the 50-period simple moving average and because price traded 1 pip below a bar that closed in its 25% lower level. And look what happened. We had a tremendous sell-off in the Australian dollar. This was in May. And all along the way that we went lower and lower, you saw these bars that closed in the bottom 25%. Each time you could have taken advantage by adding to your positions by going short. Remember, this is all ways in which to interpret what the market wants to do. And it's giving you these clues. It's telling you, right, it's shouting in front of you, this is what I want to do. So if you learn how to listen to the market, there's no reason to listen to anything else. You can still listen to news, fundamentals, see what's going on in the economy, listen to interest rates, find out what indicators are doing, but just give them only so much attention. So many people rely so heavily on those outside things, and it should be the opposite. You should maybe give them 5 or 10 or 15% of your attention and 80% to the market itself. All right, so let's look at some recent examples in multiple time frames. We just showed you some daily bars of things that happened in the last couple of months. Let's look at some things that happened very recently so you can see that this works in any direction, any time frame. And these are just examples of these three key elements. All right, here's the Australian dollar. Now going into August of this month, actually this chart was formulated all the way up until a day or two ago. As you can see here, we're above the 50-period simple moving average. So what does that tell us? That tells us that we are not in any way going to be looking to go short. We're only going to be looking to go long. So if this means we're looking to go long, we're looking for bars that close in the top 25%. And those are these bars right here. Each one of these bars would have given you an opportunity to go long and to take advantage of the next movement, which was up. Do you see how it's much more advantageous to be in sync with the market, to just basically flow with the river as opposed to trying to swim upstream? Had you tried to short this, you would have had maybe 1 or 2 days of nice profits, but wouldn't it be a lot easier just to go along with it to the upside? Let's look at another chart here, a daily chart of the euro. This is also going into the beginning of August, and right off the bat we see that we're below the 50-period simple moving average. So there's no way in the world we're trying to bottom fish the euro. There's no way we're trying to say, well, I think the euro has gone low enough, I'm going to start buying. We don't even think about buying the euro until it's been consistently 2 or 3 closes above the 50-period simple moving average. So until it does that, the only thing we're thinking about is shorting the euro. That's it. We don't have to look at any economic reports. We don't have to wait for any numbers to come out. We just think about shorting the euro. Now we apply the elements here, and we see that this is every time that we close in the bottom 25%, the market was giving you clues that it's most likely going lower. That's how simple it is. Remember, my mentors taught me to keep things as simple as possible. All right, so those are daily charts. Once again, let's look at a 60-minute time frame. Here's the euro-yen, which was going up until last Friday, just 3 days ago. Once we crossed above the 50-period simple moving average on an hourly bar chart, we had all these bars that closed in the top 25% of their range. Don't you think you could have taken advantage or applied this to any one of your strategies, or perhaps built a strategy off of this? Could have easily taken advantage of this nice move to the upside. Once we crossed above the 50-period simple moving average, the market was giving you all these opportunities to jump on board, to go long. That's a 60-minute chart. Let's look at a weekly chart of the euro yen. All right, coming into April of this past year, I believe we were below the 50-period simple moving average. So once we're below, the market was giving us clues by closing in the bottom 25%, all these opportunities to go short the euro yen. How about we want to trade a 10-minute chart? Well, here's a 10-minute chart of the British pound. This was just a few days ago. Same exact thing. We're crossed above the 50-period simple moving average. And each time we have a bar that closed in the top 25%, the market was giving us a clue that most likely the momentum will continue. If you wanted to take advantage of that, you simply could have purchased and saw the momentum continue. It doesn't always continue on the very next bar. Sometimes you have to wait 2 or 3 bars. But this is where the other elements of a strategy come into place. You have to know about money management, stop placement, exits, and so forth. These are just 3 key elements that you should have in any strategy that you're trading. All right, so let's recap. What did we talk about? We talked about these 3 key elements. Remember, they're not a strategy, but you firstly, in anything you trade, I don't care if you're in trading monthly bars or if you're trading tick charts, you must be in sync with the trend. I know firsthand because I had such a difficult time myself, my first 2 years of being a specialist, trying to trade out of sync. I would make tremendous amounts of money by picking tops and bottoms, and I thought, boy, I've got this all figured out. And then there would be one trade, I would short the market or go long, and I would literally give everything back that I worked so hard to make. And it just didn't work that one time. The one time it didn't work was because I was out of sync, and it just doesn't work. So that is really not the mindset, or those are not the actions of a professional trader. A professional trader never tries to outguess what the market's going to do, never tries to pick a top, never tries to pick a bottom. What a professional trader does is simply trade in sync with the trend, okay? And so the difficulty with people who try to trade this way is that there are just a million and one ways to figure out what the trend is. So as what we've done in keeping with our philosophy, we've kept things as simple as possible. The best way that we've found in 35 years of trading is to simply plot a 50-period simple moving average. If price is above, you automatically know you're not even going to think about looking for shorts. You're only going to be looking for buy signals. If price is below, you're not even going to consider going long. You're only be looking for short signals. That's how simple it is. Okay? It doesn't get any simpler than that. Key number 2, once we found the trend and now that we're going to be in sync with the trend, we want to look for this bar pattern. Regardless of what strategy we're trading, regardless if it's based off fundamental news, you want to see a bar close either in the top or bottom 25% of its range. Why? Because this is a clue, an extremely powerful clue the market is giving you that it's most likely going to continue in that direction. So that's your clue that we're probably headed higher or lower depending on where we close. So jump on board. This is your signal to get ready to jump on board. And how exactly do we jump on board? If we're going long, we use our entry technique, which is key 3, which is our confirmation of the momentum continuing in that direction. So we have to see it trade 1 pip above the bar that closed in the top 25%. And if we're going short, we want to see confirmation that we're going lower. This means that we have to trade 1 pip below the low of the bar that closed in the bottom 25%. Now, are these things guaranteed promises that they're always going to work? No, nothing is guaranteed. Nothing is promised forever that it will work. But we're just increasing the opportunities here. We're increasing the chances for a profitable trade. That's all we're doing. We're putting the odds in our favor. And if you notice, everything we're doing is just simply jumping on board whatever the market wants to do. And a great book, I believe it was called Trading Chaos by Bill Williams, he said, the holy grail, the key to success is just wanting what the market wants. Whatever the market is, whether it's Forex, E-mini, or stocks, just want whatever that wants. If it wants to go lower, then you want to sell. If it wants to go higher, then you want to buy. That's it. There's no reason to really complicate your trading and have to formulate all these different ways in which to discern what the market's doing. It's too complicated. It's exhausting, and there's only a few relatively few amount of traders that are able to do that with consistency. Most of us will do it, and then it'll work great for a couple of days, a couple of weeks, maybe even a couple of months or years, but then it'll fade. It won't work anymore. So we want something that is more consistent, that has stood the test of time, that will work, and that we can rely on, and that will sustain us. And these are some of the things we teach, these 3 keys here. Now, points to remember, extremely important, extremely, extremely important. Points to remember, this is not a complete strategy. So many people will, I've taught before, different webinars, I've spoken in front of crowds. I've spoken about this before where they'll say, oh boy, this is amazing, I'm going to go start trading this today. This is not a strategy. These are elements that you should have already in place in your strategy. But they are not a complete strategy. You just can't simply go out and start trading this. You have to know about stop placement, money management, how many contracts or lots you should be trading, if you should be having your stop placement rise, if you have a nice profit, should it be tracking the trade? You have to know about exit signals. Where are you going to get out? We showed you where these nice trends move, but where would you exit? Some of them had a nice 100-pip gain, and then they turned the wrong direction. So would you have gotten out, or would you have held on? How would you have, taken your money out of the trade? You also have to know about money management. How many, once again, how much should you risk per trade? Where is your stop going to be so you'll know exactly how much risk? These are all very important things, and so many people ignore because they simply want to jump in and think that it's going to work and it's so easy. Well, trading really is simple, but it's not easy. And the reason why it's not easy is because we get in our own way. That's really what it is. It's what it comes down to. It's not that we have a faulty strategy or because it's too hard figuring out what the news was. It's just we get in our own way. We make things too complicated. Simplify your trading, and it will get you on that road to consistency. Okay? Now, as I just stated, you have to have all these things to have a complete strategy. I know a number of people, especially beginners, will say, well, Steve, I don't know about these. I don't understand stop placement, or I don't know about money management. I like what you said here. That's what we provide as a service, as specialist trading. That's what we provide. We provide strategies. We provide information. And most importantly, we're not just a company that provides you with signals, even though we do. We really provide you with education. All right? So I want to offer to all of the attendees today a very great discount we're having on our Forex Momentum Trader course, which is basically built off of the 3 key elements that I showed you today. Okay? This is our Forex Momentum Trader strategy number 4. Strategy number 4 uses and incorporates all these elements we talked about today. Should you decide to become a member, you will get immediate online course access. This comes detailed instruction with 4 videos, and I go exactly into entries, how to enter into the position, aggressive as well as conservative entries, where to exit the trade, and also where to place your stops. We provide you with 1 year of trade signal alerts if you're looking at daily bars, so that you can apply this so you'll know and see if you're understanding the process. We really don't want to just force feed you signals. What we want to do is use them more as a bouncing off informational approach, so that if you see signals to go long the euro dollar, let's say, you want to make sure that your homework is okay, and if we provide you with a signal, which we do the night before, you'll know that you were in sync with the actual strategy. Now, this also comes with 1 year weekly trading lessons. We have trading lessons that will elevate and will give you a more advanced way of looking how to trade. Everything's on a PDF, so you can print this out and learn at your own leisure. And then we also give you personal email access with myself. So if you have any questions, if something doesn't make sense, you can always email me, and this can always help explain things right off the bat. So you don't have to wait 2 weeks. So many times I answer you within the hour. Okay. Now this Forex Momentum Traders course usually runs for $695, which in itself is a very inexpensive price, as you can see some of the examples I showed you today. But we're reducing this for FX Street attendees today down to $495, $200 off. It's for a limited time only. Now I just want to show you a couple of remember we stated that we give you 1 year of trade signal alerts. These were signals that were given to our members in this last month or so. In the beginning of July, we issued a buy signal in the Swiss franc on the 2nd of July. And as you can see here, the very nice run-up we had in that particular trade. This was another signal that we had in the Canadian dollar, which was just going into August, 2 trades to go short. One generated 90 pips, the other was 100 pips. And these were actual signals from the night before, where you knew where to enter, where to exit, where to place your stop, and how to stay in the trade longer if you'd like to. All right, this is what we teach, and we also provide all of our members who sign up with free signals. Now, once again, if you have any questions concerning, anything, the course or anything we have on our website, I invite you to go to the microsite that FX Street has put together for us. That is the elongated version here of the link. We've shortened it down so you can copy it down real quickly. I'll give you a few seconds to copy that down. Once again, this gives you more information about our company. You can find out more about our information on our website, some of the course descriptions, some of the things that we offer, more bio about myself. I'll go to that page right there and you can see, you simply go there and it'll tell you more about what we do, the education we provide, and a little bit about my background and how long I've been trading. All right, we have a good 20 minutes now, 15 minutes left in the presentation. As I stated, I thank you so much for waiting. I see some people couldn't wait. They're starting to ask questions already. That's okay, but thank you so much for waiting, the majority of you, for waiting to ask any questions. I just want to leave these up here while I answer any questions. If you want to go to our sister site, which is protraderstrategies.com, you can get information about our educational courses. And if you have questions, if we run out of time right now, or say you come up with a question once we've concluded or left this presentation, you can always email us. Our VP of Research is Brett Marsh. You can email him at brettm@specialisttrading.com or call us directly at 310-844-7220. Okay, let me see if I go back here. I'll try and go back a little bit. Farhan asks, what would happen when price is in between the SMA? That's a very good question, Farhan. What we look for is at least a consistency of 3 to 4 closes either above or below. So many times price, let's say price is above the 50-period simple moving average, and it'll come down there and then oscillate. Close above, close below, close above, close below. We want to see at least 3 to 4 consecutive closes in one direction, either on top or below, to tell you what the direction is. Okay. Now, this doesn't mean you have to trade. If there's any doubt in your mind, if you think that price is, just oscillating back and forth too much, you can stay on the sidelines and look at another market. So there's no, requirement that you must take a trade. But if you have a really strong idea, let's say your strategy is giving some type of a buy signal, you should have at least the last 3 to 4 closes be consistently or consecutively above the 50-period simple moving average. Okay. If you want to go short, you should have 3 to 4 consecutive closes below the 50-period simple moving average. That's a rule of thumb that we use. Okay. I hope that answers your question. Another question is, if a Doji candle, key number 2 may be used. No. Well, first of all, a Doji, it doesn't matter whether we're using candlesticks or not. We just want to see that a bar closes in the top 25%. Now, a Doji candle, this is a good question, Jack. A lot of people will not know what that is. Basically, a Doji candle is just a bar that opens and closes at the same price, or roughly the same price, 1 or 2 pips discretion. That is more something for advanced traders. We have used that in the past, but we only really use that for advanced traders, and you don't see that often as much. I would, in this presentation, I'm just mainly trying to focus on the key fundamental elements, and I would basically more look for a bar that closed in the top 25 or bottom 25%. Okay. I just want to don't go too much in detail into something that's too advanced because it requires other information, and then we'll go off on a totally different topic. So for these key elements, it's better to look for a bar that either closes in the top or bottom 25%. Because if you think of it, if you strip away when the bar closes, what time or how many ticks or whatever time frame you're using, if we close, towards the ends, the high or lows of those range, once again, this is just a clue that the market is telling you it's most likely going to be continuing in that direction because that's where it was before the bar stopped. Okay, so that's all we're saying. That's all we're trying to find. So we're looking for a continuation of trend or a continuation of momentum. Okay, how about if the 50-period simple moving average is a downtrend in the daily chart, but the uptrend on the 1-hour chart? Okay, that's a good question. I think if you allow me, I'm going to go back here to show you because I know a lot of traders like to use that. They like to look at higher time frames to determine what the lower time frame is. And that's valid. I personally, after 35 years of trading, have found no consistency to that method. I know a lot of traders swear by it. A lot of educators you come here to talk to say this is the way you should trade, and that's fine. I will not dispute it. I just personally have found no consistency in that. What I teach my students is that if they must feel comfortable with that, that's fine. go ahead and use the higher time frame direction and where price is in relation to the 50-period simple moving average to determine what the lower time frame is. But personally, I just take each chart for what it is. If I'm looking at a 15-minute time frame, that's the only thing I'm looking at. Where is price in relation to that moving average? I don't care what the hourly or the daily bars look like. If I'm trading daily bars, I don't care what the weekly bars look like. I just look for each chart on its own. I hope that answers your question. So once again, I'm not saying there's anything wrong with it. I personally have found no consistency with using that method. I just really haven't. And so I would much rather just take the initial chart for what it is. All right? Let's go to the next question. This just comes down to how often you want to trade. Yes, well, everything really, if you look at anything, comes down to how often you want to trade. If you want to trade a lot, you trade smaller time frames because you'll get a lot more signal. If you don't want to trade a lot, you trade daily or weekly bars. And that's one of the most important things you should ask yourself. This is another thing we teach all our students. How often do you want to trade? How do you want to get paid? Do you mind not seeing your profits till the end of the month? Well, if you're okay with that, well, then you're more of a position trader or intermediate term investor. If you want to get seeing that you're making profits each and every week, then you should be trading intraday because you're going to be trading a lot more. This is one of the things that basically everything does come down to how much you want to be trading, yes. Jack says he's confused. 25% of bars top side or bottom side, or range of few bars, 25% of range top or range bottom. When we're saying that 25% of the range top, we're saying 25% of the range the entire range of the bar. Not, so in other words, if the bar is 100 pips, let's just say, it must we want to close in the top 25 pips. That's all. If the range is 100 pips again, and we want to go short, we must close in the bottom 25 pips. Okay, I hope that makes sense. But it's the range of the entire bar. Okay, so just figure how many pips are in the range and then divide by 4. Okay, that top 4 or that bottom 4 level is where you want to be looking for. Is this strategy number 5? Jiva asked. No, this is not. Strategy number 5 is a totally different strategy. It's totally built off of different things, and it's also a swing trading momentum type, but it's built off of a pattern recognition. This is not. Strategy number 4 is not the same thing at all, and it's a totally different strategy. Strategy number 4 and 5 and 6 are our best strategies to date, and these are the ones we really promote and teach our students that want to learn about trading. Strategy number 5 is a great strategy as well as 4 and 6, but this is totally different. It goes off of the same fundamental and sound techniques of using that 50-period simple moving average and looking for where we close, but it has a couple of other elements included. Okay. If the PA is if the price action is above the simple moving average and a candle opens and closes in 25% upper range as a bear candle, shall we take it as a signal candle? Well, first of all, remember, this is not a signal. This is not a strategy. You only take signals that are in strategies. I was just showing you some techniques, okay? But that's getting a little bit more involved here. That's more of a strategy. Once again, just apply these techniques of what we talked about, these elements, because I don't want to, start getting too involved in saying, yes, you should take that as a signal. You need a lot more other things involved, and even though they're very simple, you have to know the process. And this is what we teach in the course. You just saw in those 3 slides, I'll go back, how simple it is. This was in the Canadian dollar right here. Now, we went short. This was not a bear candle. We just closed in the bottom 25%, okay? And the thing about strategy number 4 is that we weed out. If you notice in the examples, there were a lot of bars. We tell you which is the best bar to go short. Now, this bar closed in the bottom 25, so did this bar, so did this bar. But we didn't go short there. We picked this bar, which gave us the highest opportunity for success. Same with this bar as well. We didn't use this bar to go short, which closed in the bottom 25%. So there's a lot of different things. That's why I don't want to get too involved in it, because there are, it's not fair to the students who have already purchased this particular method. And also, I didn't give you everything involved in the strategy. Just use these techniques and apply them. You can use them to a strategy that you're currently trading, or you can make your own strategy based off of that. Okay? Farhan asks, in that case, what if it goes 1 pip above and then comes down, creating a wick? What do we do then? Well, remember, if it goes 1 pip above, that would be your entry, regardless of what strategy you're trading. Once you're in the trade, two things are either going to happen. You're going to exit with a profit or you're going to get stopped out with a loss. That's it. Now, in order to know that, you have to know where you're going to be exiting, what your exit level is, and you have to know where your stop placement is. These are all things that come with the strategy. If I gave you that to you now, then it wouldn't be fair once again to the people that have already purchased the strategy. You're getting a great discount, $200 discount in the next couple of days to use this. As you saw, the last couple of examples I just showed you would have paid for the course many times over, just those 2 trades in this past month. So if you're interested in learning more about what to do then, call up our number here. We can give you more information or speak to our VP of Research, Brett Marsh, at BrettM@SpecialistTrading.com. We can answer questions about that. The next question is, 50-period simple moving average apply to higher low of or close? Oh, good question. The 50-period simple moving average is always based off of the close. That's a very good question, and a lot of people always ask that. And people also ask, well, why can't we use a exponential moving average or a weighted moving average? That's fine. If you want to use that, those are okay. We have found that the simple moving average works the best. Even though we're not a statistical company, we don't do research in terms of finding out exact numbers going back 10, 20 years. Remember, we're an educational company. We have just seen through sight that on face value, the simple period moving average works the best. But if you feel that you must use an exponential moving average or any other type of moving average, that's fine. It's more of the concept that we're concerned about. Remember, the concept is we want you in sync with the trend. It's not so much about this has to be the exact tool, this has to be the exact moving average. We want you in sync with the trend. Now, if you find something that is a much better trend type of indicator, that's fine. Okay, but for our students, this is the simplest thing, and this has really stood the test of time. How about the 100 or 200 period simple moving average? Well, here's one thing to know. The further out you go with moving averages, the longer your time frame. So if you're using a 50-period simple moving average, it pretty much encompasses all, anything from intraday to daily bars to even weekly bars. If you're using 100, now you're starting to get into more swing trading, daily bars and weekly bars. And if you're using a 200, you're looking at weekly bars to monthly bars. So, our company basically teaches anything from intraday trading to intermediate term trading. That's why we use the 50. It seems to really encompass all of that time frame. We don't use the 100, even though there's nothing wrong with these. But if you're going to be using these larger moving average time frames, that's fine. Just remember, they should be used for larger time frames, for dailies, weeklies, and monthly bar charts, not intraday trading. All right? Vicky is asking, is this webinar being recorded? I'm not really sure. Once again, it's probably good that you're addressing Vicky on this, because I personally don't know if it's being recorded or not. But once again, if you want more information about anything that we have on our site, let me just take you back to the Microsite. Here's the link once again. This will give you a lot more information about what we offer, a lot more about our pricing. You'll see that we're really giving you a great discount today about concerning our strategy price for all the attendees today. And this will take you to this Microsite, which will give you more information. You'll be able to find out about all of our course descriptions, and you'll get information about myself and how I started trading and how long I've been trading, and basically what my background is. Mike asks, Steve, many traders use the 55-period simple moving average, fib number. Have you compared the two MAs over the years? That's a good question, Mike. No, I know a lot of traders like to use that, and a lot like to rely on the fib. That's fine. I don't really think there's going to be that much discrepancy between the 50 and the 55. As I stated before, if you feel totally comfortable using the 55 and that's what you relied on, that's fine. This is not something that's written in stone that you can never break this rule. Remember, what I'm trying to pass on is just that you're in sync. As long as price is above either of those moving average, or even if you want to use the 200, that's fine. But just remember, the further out you go in the time frame of the moving average, you should only be applying that to further out time frames of the currency pairs. All right, a 200 moving average should not be used for an hourly chart. It's just you're giving yourself too much room. A 200 moving average should be used for a weekly or a monthly chart. That's why we use the 50, because it pretty much encompasses everything. All right, but there's nothing wrong with the 55. That's fine. Let's see, the next question. Do you have a book on the theory instead of taking the course? Not really. I have a book, but that's more about my experiences of trading on the floor, not really about the theory. this is what we provide for all of our students. Remember, we're an educational company, so we really mentor you and giving you 35 years of my trading experience, and you learn roughly in just a matter of weeks or even months. So you're really, if you're struggling with your trading, if you're really trying to get at a point where you just want to be consistent, you've finally bitten the bullet and said, you know what, it's not about making a home run every trade. I can't do that. I don't know how people do that. I don't know how educators promise that to me. Well, we're not promising that. What we're trying to do is instill this level of consistency. It wasn't until I turned my way of thinking around that I tried to go for those home runs, and I stopped wishing for that. And I just said, you know what, I just want to have this 2-step forward, 1-step back approach, that I got on that road to consistency by keeping things simple. And as you can see, I've been trading 35 years now. So that's really what the definition of success is. There are so many traders I knew that were multimillionaires that have been totally wiped out. So how good was their strategy? How good were their methods if they don't even have any capital to trade anymore? What the really definition of success is, what we try to teach, is consistency. You want to be trading 20, 30, 40 years down the road. And one thing which I mentioned, I know there's a lot of speakers here and a lot of people that teach, and they all have great ideas, but listen to the ones that have been trading 20, 30, 40 years, such as myself. Most of them have very simple, very concise ways to trade. That's why they've been trading that long, because they've learned to keep things simple. It's the ones who've been trading 5 or 10 years, who just started out in the game, that have all this convoluted theory and all this, this tremendous systems and strategies. Those things, I'm not going to badmouth them, but it's just that they're very complicated. We try to keep things as simple as possible. You'll find that the traders that have been trading 30, 40 years have extremely simple methods. That's what we're trying to instill in you. But hopefully we don't want you having to learn that in 20 to 30 years. I'd like to teach that to you in a matter of months. Okay? Well, we're just about out of time. I thank you so much. Once again, here's where you want to go if you want to learn more about our strategies. We have a sister site which basically just sells and promotes our strategies, proprietary.com. We also can contact us. You can call us at 310-844-7220 and speak to us directly, or talk to my VP of Research, that's Brett Marsh, and email him at bretm@specialisttrading.com. Thank you once again for attending. I hope you take advantage of the great discount that we have for this particular strategy that is built off of these 3 key elements. And I want to thank all the people at FXB for giving us the opportunity to speak. Thank you so much to Maud and everyone there, Vicky. And we'll see you next month. Have a great trading day, and be sure to email us if you have any more questions. Bye-bye.